Hello and welcome to a new series of videos on basic accounting. And as the name suggests, we'll be covering the basic concepts of accounts. So, since this is the first video, we're covering the introduction part, definition of accounts. So, in the series, we'll be covering definition, the classification of accounts. Slowly, we'll move ahead and start passing journal entries, posting those entries into ledger accounts, preparing the trial balance, and finally, preparing the income statement and the balance sheet. So if you are new to account, these terms may not be familiar to you. But we'll try to prepare the videos in such a way that if you watch them in a sequence, at the end of it, I am sure you'll be able to tally the balance sheets on your own. So let's begin. Since it's basic accounting, we're beginning with the definition. Definition of accountancy says accounting is a systematic process of identifying, recording, classifying, summarizing, and interpreting what? Interpreting business transactions. So let's break down the journal entries. Let's break down the definition. Now, in order to prepare accounts for a business, we must understand that the accounts are prepared for the business, so you have to look at the transactions from the business point of view. So for convenience purpose, let's take example of these transactions and we'll assume that we are passing the journal entries or we're preparing the accounts for my business. Let's say I run a business of coaching classes. I teach accounts and economics to commerce students. So these are the transactions that belong to my business. So when we identify, classify, record the transactions, we have to do it from the point of view of the business for whom we are preparing the accounts. So as the definition says, we have to first identify the transactions. So here's a list of transactions that I've given. The first one says purchased on credit from X, office supplies of rupees 2000. So, do you think this is a business transaction? We must first identify the business transaction. Is this a business transaction? Yes, because I run a coaching class and I need office supplies, printing stationery, duster, and markers for my business. So, I purchased printing and stationery material, office supplies. Second says received tuition fees rupees 10,000. So I received fees from the student. Is this a part of the business? Yes. So this is a business transaction. Next, purchased groceries for home. Now this is my personal transaction. Groceries have nothing to do with my business. So this is not a business transaction. Next, paid residential property tax rupees 1200. Now paying taxes, that sounds like business. But I paid property tax for residential property. So if I pay taxes for my residence, it does not belong to my business. So this is not a business transaction. Suppose I pay taxes for my commercial property, the place where I run my business, then that property tax would have been a business transaction. Next, paid salary to receptionist rupees 5,000. Now receptionist, she helps me in the business. So that means this is a business transaction if I'm paying her. So out of 5, we've identified first, second and fifth transaction. These are business transactions. So we are through the first part. Accounting is a process of identifying. We have identified the business transaction. Next comes recording. Now we need to record these transactions in the books of accounts. But to record the transactions, we have to first classify them. Classify these transactions, the accounts that, let's say for example, purchased on credit from Mr. X office supply. So office supply is an account. Mr. X is an account. Paid salary, let's say paid salary in cash. So cash is an account, salary is an account. So we need to classify these accounts before we record them. So recording and classifying. Now we'll come back to classifying and passing journal entries here. Let's just finish the definition first. It says summarizing and interpreting. So summarizing would mean once you pass the journal entries, first you classify the accounts, then you pass the journal entries, the entries are then posted, shifted to the ledger accounts. In some countries we call it T accounts. So we post it to T accounts, then we prepare a trial balance. The final stage is interpreting. Now we've recorded all the transactions, but as a business, we need to know whether the business has made profit or not. What are the assets and liabilities at the end of the year? So interpreting the financial results means we need to prepare the income statement or the profit and loss statement, and we prepare the balance sheet. So the last part would be actually preparing the financial statements. So here we cover the definition: identifying the business transaction, recording the business transactions. But for recording, we need to first classify the accounts. So classify them, record them. Now record them as journal entries, but summarize them in ledger accounts, then prepare a trial balance, and then finally prepare the financial statements: income statement, balance sheet, statement of equity, and so on. So since this is the first video in the series, let's not get into interpretation area now. We'll stick to the classification. Now, classification: how do you classify the accounts? Any type of business transactions will have certain accounts that would get affected. Now, for example, receive tuition fees. Tuition fees is what? Tuition fees is my income. So, income account is getting affected. Now, received in cash. Cash is an asset. So, cash is getting affected. Similarly, here, Mr. X, I purchased the office supplies on credit. I have not paid Mr. X. So, see, when we owe money to someone or someone owes money to us, we owe money to someone, our creditors. Someone owes money to us, our debtors. Do we have to remember their names? Yes. When we have to pay someone or we have to receive something from someone, we must remember their names. So we record the transactions in their name. Later on we'll understand, we'll call them personal accounts. We're going to classify them as personal accounts. So X is an account that is getting affected, and we purchased office supplies or printing stationery. So this is one account that is going to get affected. So we need to first identify, classify, and record. In this video, we are going to stick to the first three parts of the definition. Summarizing and interpreting, let's leave it for the next set of videos. Now, since I said in order to pass journal entries, we need to first classify the accounts, and there are three types: real, personal, and nominal. Let's proceed. We'll begin with personal. We'll begin with nominal first. Nominal accounts are four things: revenues or gains. So revenue from the business or any kind of capital gains, any kind of profits that you receive will be classified under nominal accounts. Expenses or losses, if the business incurs any kind of losses, or it's spending, like example printing and stationery, it's an expense for the business, so that comes under nominal account. Now these nominal accounts, any kind of revenues, incomes, gains, expenses and losses are always written off or closed at the end of the financial year. Now what is the financial year? Financial year could be 1st April to 31st of March, or 1st Jan to 30th 31st of December. So at the end, let's say 31st of March or 31st December, on this date we close these accounts. They are transferred to the profit and loss account. This goes to the income statement or the profit and loss statement, and these accounts are closed. So all nominal accounts, they are not carried forward to the next financial year. They are not carried forward to the next accounting year. They are closed at the end of the accounting year. So nominal accounts, what are nominal accounts? Any kind of expense, losses, gains, revenues, incomes. These are nominal accounts. And what happens to them at the end of the accounting year? They are closed. They are written off. Next category is personal accounts. Now, whenever we're referring to a specific person or organization, then we call it personal account. Now, for example, purchased on credit from Mr. X office supplies of 2000. Now, since we have to make a payment of 2000 rupees is due. So, in that case, we need to remember Mr. X's name. So, here we'll prepare X's account. X's account will be personal account. Let's say we've rented this premises from XYZ Limited. We've rented out this premises from XYZ Limited, and the rent for this particular month is due. So 10,000 rupees rent is due. So XYZ Limited becomes my creditor. We need to remember its name. So we'll prepare an account in XYZ Limited's name. So that becomes personal account. Now this personal accounts, where do they go at the end of it? Now let's say In case of nominal account, we said they belong to the income statement and they're written off, they're closed. But that's not the case with personal accounts. Personal accounts, simple to define, they're individuals or organizations, specific individuals or organizations like Mr. X or XYZ Limited, or sometimes salaries payable. If I have 10 employees and the salaries are due for, let's say, last 2 months salaries are due, I may not list each and every employee's name. I can just call it salaries payable. I can put together my liability and call it salaries payable, or I can call them debtors or creditors. Now, these can be assets or liabilities. Suppose 10 of my students have not paid the fees. So, I can record the entries individually in individual student's name, student A, student B, student C, and so on. Or I can just sum it up together and call it accounts receivable. That is tuition fees receivable. So that becomes an asset. If I'm going to receive something from it, since the money is due to me, that is an asset. So a personal account can be an asset or it can be a liability, like in case of Mr. X. I have to pay, that means it's a liability for me. So personal accounts are individuals or organizations. It can be independent but single individual or single organization, or we can club them together, call it salary payable or debtors or creditors, and these can be assets or liabilities. Now they are seen on balance sheet. Now personal accounts are seen on the balance sheet, and most of the time they are current in nature. They are more like current assets. Now what are current assets? We'll get into this topic in the next set of videos. Let's just understand these are mostly current in nature and they belong to the balance sheet. So far, nominal accounts, only four categories: revenues, incomes, gains and losses and expenses, and they go to the income statement and they're written off, not carried forward to the next accounting year. Next we saw is personal. Personal accounts are individuals or organizations. You may identify each and every individual or organization, or you may club them together. Now they can be assets or liabilities, debtors or creditors, and they go to the balance sheet. One more speciality about them, they are more current in nature. Now what is current assets? We'll get into it in the next video. Third category of accounts is real accounts. Real accounts are also called as permanent account. Now don't get misled by the term permanent. This permanent word is given only to express that this particular category of assets or liabilities, they are carried forward to the next accounting year. So they'll go from one accounting year to the other. For example, cash balance. So at the end, 31st December, do we spend all the cash and finish it off? No, we'll carry it forward to the next accounting year. Let's say my accounting year starts from 1st Jan to 31st of December. So 31st of December, am I going to spend and finish off all the cash? No. If some cash remains, bank balance remains, I'm going to carry it forward to the next accounting year. Similarly, land. I'm not going to sell land or property. Stock or goods. So let's say now in my case, this is a service industry. I teach coaching classes business. Suppose if I'm into trading business, trading of printing stationery, let's say markers and dusters. So the stock that remains, closing inventory that remains, that is an asset. So at the end of the year, if all my stock is not sold, some stock remains, am I going to throw it off or dispose it off or write it off? No, I am going to carry it forward to the next accounting year. So stock or goods. Same applies to equity or share capital. In my example, my share in the business, my equity in the business will remain in the next accounting year too. So permanent is only because they are carried forward to the next accounting year. So the accounts are classified in three categories. We understood, and nominal goes to income statement. The remaining two can come to balance sheet. Now, what next? We said that in order to pass journal entries, we must classify the accounts. Now, we've classified the accounts. Now, what? On the basis of classification, the rules apply. Now, these are three golden rules of accounts. They are called golden rules of accounts. Why? The first step to accountancy is, the first step to recording the entries is passing a journal entry. To pass journal entries, you must know these three golden rules. The first golden rule for real accounts, It says debit what comes in. Debit what comes in. So, for example, I received tuition fees from one of my students. Received tuition fees of rupees 5,000. Received tuition fees of rupees 5,000 in cash. What is coming in? Cash is coming into the business. I said when we pass journal entries, we must look at it from the point of view of the business. So for my business, what is coming in? Cash is coming in. So debit what comes in, credit what goes out. Credit what goes out. Again, since cash is a real account, we are going to apply the rules that are applicable for real account. So when I said I received cash from my student, it will have to be debited because it says from business point of view, debit what comes in, credit what goes out. Example, I paid salary to my receptionist rupees 5,000. So from my business point of view, cash is going out. Cash is going out, which means I have to credit the cash in this transaction. The transaction where I'm receiving fees, I debit the cash. Why? Cash is a real account and the rule says debit what comes in. The transaction in which I am making a payment, I am crediting the cash account because cash is going out and the rule says, for real account, the rule says credit what goes out. Now, what about the other part? What happens to office supplies? What happens to the salary? What about salary? You have spent 5,000 rupees on salary. So, let's proceed and let's go to the next category, nominal account. So, for nominal account, the rule says debit all expenses and losses. Debit all expenses and losses. Credit all incomes and gains. Credit all income and gains. So, as we said, nominal accounts are only of four types: revenues or incomes, gains, you call it by any name, and expenses or losses. So, all expenses or losses would be debited, all incomes and gains are credited. Now, in my example, received tuition fees. So, I am receiving tuition fees for me, for the coaching classes business. Tuition fees is an income. So, tuition fees would be debited or credited? Credited. Credit all incomes and gains. Tuition fees is an income, so it will be credited. Debit all expenses and losses. Paid salary. Since I am paying salary to my receptionist, it is an expense for my business. Expenses and losses. Debit all expenses and losses. So salary would be debited. Now we'll pass a journal entry with this. Let's proceed to the third category first. Now the third category is for personal accounts. Personal accounts. So debit the receiver. Debit the receiver. Credit the giver. Debit the receiver. Credit the giver. So debit the receiver. Credit the giver. Do we have any credit transaction example? Yes. Purchased on credit from Mr. X supplies of rupees 2,000. Now, Mr. X is a giver or a receiver? Mr. X is a giver. He is giving us printing and stationery and is not receiving anything in return. So, he is a giver. So, we will credit Mr. X. We will credit Mr. X. Now, let's say these are the transactions. Let's try and pass journal entries on the basis of this. Now, for the receiver, let's take another example. I paid advance salary. I paid advance salary to my peon or my driver. I paid advance salary to my driver, rupees 5,000. Now what happens? Advance salary means he's not given me any services yet. He will be giving me his services in the next month. He'll be driving my car next month. I am giving him advance salary. So since he is the receiver, I'll call him my debtor. So he is, let's say, Mr. D, the driver. He becomes the receiver. Debit the receiver. So let's pass journal entries on the basis of these classifications. The first transaction says purchased on credit from X office supplies of rupees 2000. Now here are two accounts that get affected. One is office supplies and the other one is Mr. X. Office supplies is an expense. Printing and stationery, it's an expense. So for expenses, what is the rule? Debit all expenses and losses. So the journal entry would be office supplies account debit 2000, office supply account debit. Now these are the debit and credit columns. Office supplies account debit 2000. Now 2, what is credited? Is anything going out? No, but there is a giver. Mr. X is a giver. Credit the giver. Since X is a personal account, we'll apply this rule. Expenses is a nominal account. We apply this rule for office supplies and we apply this rule for personal, that is Mr. X. Credit the giver. So office supplies debited and Mr. X would be credited for 2000 rupees. And here we'll write the narration being office supplies purchased on credit. This is called as narration. We explain the transactions in short. So being office supply purchased on credit. Now this is first transaction, first journal entry that we passed. What about the second one? Received income as tuition fees of rupees 10,000. Now tuition fees, what type of account is it? Tuition fees is my income. Income is a nominal account. So nominal account says credit all income and gains. So income will be credited. And what did I receive? Cash. Cash is a real account. Cash is a real account because at the end of the accounting year, we don't write it off. We are going to use it for the next financial year, next accounting year. So, for cash, real account rule says debit what comes in. Now, when I am receiving tuition fees, I am getting the income. So, that means cash is coming into the business. So, debit what comes in. Cash account would be debited for 10,000. 2. Tuition fees. Tuition fees received, debited 1000 and tuition fees credited 1000. So we applied the real account rule for cash and we applied nominal account rule for tuition fees since it's an income. Cash is a real account. Similarly, office expenses. So we applied the nominal rule. Mr. X, it's a personal account. So we applied the personal rule. Last one, paid salary to the receptionist 5,000. So salary is an expense. Paying salary is an expense. Expense becomes a nominal account. Rule says debit all expenses and losses. So salary account would be debited for rupees 5,000. 2. What is going out? Cash is going out. When I pay cash, cash is going out of my business. So cash is a real account. Real account rule says credit what goes out. So salary account is debited to cash account credited by 5,000 rupees. Being salary paid, narration, being salary paid to the receptionist. So this is how you pass the journal entries. Now since this was the basic, I was just explaining the basic concepts, we passed just 3 entries. In the next set of videos, I'll try to take examples of some 10-12 transactions, business transactions, and we'll try and post journal entries for the same for practice. So I hope you understood. So in summary, we understood the definition but only the first 3 part, identifying, recording and classifying. We'll come back to this later once we are done passing journal entries. When we start posting those entries into ledger accounts, we'll come to summarizing and then finally interpreting. So the video covers the 3 types of accounts, classification of accounts, and we learned the most important 3 golden principles of accounts. Real account says debit what comes in, credit what goes out. Nominal account says debit all expenses and losses, credit all incomes and gains. Personal account says debit the receiver, credit the giver. Once you know how to classify the accounts, which account goes under what category, real, personal or nominal, and you know the 3 golden principles, you're ready to pass the journal entries. I hope you understood the basics. We'll come back with some more transactions and try to pass journal entries on them. Thank you for watching.